Today, we're diving into the fascinating journey of Sofi, Social Finance, Inc., a fintech powerhouse that's been on quite the ride over the past few months. The tale of a tumbling stock, a 37% drop explained. Imagine you're at a theme park and you're on one of those giant roller coaster rides that suddenly takes a steep drop. That's been the journey for SoFi stock recently. In January, investors were possibly partying as the stock hit its peak. Then, as if on cue, the ride began to drop, 37% down from that high, even after a couple of hopeful rebounds. But what exactly went down? Let's break it down. High expectations and market euphoria. In January, SoFi's stock price was riding high on investor optimism. Much like that feeling when you find an extra fry at the bottom of the bag, the market was extra excited about the fintech company's promise. Investors were betting big on a future where SoFi would completely reshape financial services, blending technology with personal finance seamlessly. Profit-taking and reality checks. As we've seen countless times in the market, there comes a point when the euphoria fades and reality sets in. Some investors began taking profits, leading to sell-offs. It's like when you're at a party, and just as the music gets louder, someone accidentally spills the punch. Suddenly, everyone gets cautious. Wider market dynamics. It isn't just SoFi that felt the squeeze. The broader market has been in a state of flux for several days. Global economic jitters, concerns about inflation, and shifts in consumer spending have all played their part. So while SoFi's fundamentals remain strong, the stock price was dragged down by overall market volatility. Think of it as a super talented athlete being carried off the field not because they're injured, but because the entire team's morale is down. Investor sentiment and short-term pain. Sometimes the market punishes you for being too optimistic, or even simply because there's too much uncertainty in the air. The fact that SoFi's stock rebounded slightly after that deep dive shows that investors are still confident in its future, but with a bit more caution now. The volatile market. What's causing the wild swings? Now, let's take a detour into the broader stock market. These past few days have seen a level of volatility that would have even the most seasoned traders clutching their smartphones. But why is everything so up and down? Economic headwinds. Global economies are grappling with inflation, and central banks have been turning up the heat by hiking interest rates. A rise in interest rates is like suddenly putting a speed limit on a racetrack. It slows down the momentum of high-flying tech stocks, including fintech firms like SoFi. By the way, if you are benefiting from the content so far and want more like this, hit the subscribe button, turn on the notifications bell, and comment the word more. Just go ahead and type the word more so I know. Now that you've commented, let's continue. But also note this: bad companies can blow up your portfolio. Consistency is good, but might not compensate you for bad companies. The difficult part is how to pick great companies. Become a member to get member-only videos about stock updates that could change your financial life. Find the link in the video description section below. Geopolitical tensions. Uncertainty isn't confined to economics. Worldwide geopolitical events have a way of rattling investor nerves. Think of it like driving through a foggy night. You need to slow down and be extra cautious, and that's exactly what investors are doing. Tech sector corrections. Fintech and tech stocks, in general, often experience corrections after prolonged periods of explosive growth. The market had been overenthusiastic, and now it's time for a reality check. It's similar to when a viral dance challenge loses steam after everyone's done it for a while. What was once the coolest thing becomes just another trend. Macro uncertainties. With talks about potential recessions and shifting fiscal policies in the air, a lot of money is being moved around reactively. Investors are hedging their bets, sometimes in ways that can be counterintuitive to the long-term prospects of companies like SoFi. Even with these bumps in the road, many analysts and savvy investors believe that market volatility can create opportunities. Lower stock prices might just be a chance to buy quality assets at a discount. You know that feeling when you catch a sale on your favorite pair of sneakers? That's what smart traders look for in a volatile market. SoFi's business. Strong momentum in a growing market. Let's pivot to the bright side. Despite the recent dips and market jitters, SoFi's underlying business continues to show robust momentum. Here's what makes SoFi stand out from the crowd. Consistent outperformance. History tells us that SoFi has a knack for outperforming its own expectations. In the past, The company has set ambitious targets and then gone on to beat them, much to the delight of investors. Imagine a chef who not only meets your expectations with a gourmet meal, but then surprises you with a secret dish you didn't even know you loved. Diverse revenue streams. SoFi isn't just a one-trick pony. Its business model spans a range of financial services, from lending and personal loans to investing and banking services. This diversity helps cushion the impact of downturns in any single sector. It's like owning a vacation home in a place with a bit of everything, from beaches to mountains, ensuring a good time no matter the season. Technological innovation. Innovation is the heart of fintech, and SoFi has been busy innovating. Their commitment to integrating advanced technology into everyday financial services sets them apart. It's like having a smart assistant that not only cleans your house, but also gives you gourmet recipes, an all-in-one lifestyle upgrade. Long-term growth prospects. With a large and growing customer base, SoFi is well-positioned to generate increasing earnings over the years. This potential for growth isn't just theoretical. It's driven by real product successes and consistent market expansion, particularly among younger demographics like Gen Z, who crave more personalized, tech-friendly financial solutions. Personal loan securitization, a major leap forward. One of the most intriguing recent announcements from SoFi is its move into personal loan securitization. Now, you might be wondering, what on earth is securitization? Don't worry, here's a breakdown. What is securitization? In simple terms, securitization is a financial process where loans, in this case, personal loans, are bundled together and sold as securities to investors. It's like taking a batch of your favorite cookies, packaging them in a fancy box, and selling them as a gourmet treat to those who want a little taste of your secret recipe. Why is it a big deal? For SoFi, this move represents a significant leap in diversifying its business and revenue streams. By tapping into the securitization market, SoFi can free up capital, lower its funding costs, and improve its balance sheet. This additional flexibility can be a game-changer for a company looking to scale its operations even further. From an investor's perspective, securitization can offer a new asset class that provides steady cash flows. For customers, it potentially means access to more competitive rates and a broader array of loan products. It's a win-win situation. Think of it as upgrading from a tricycle to a turbocharged go-kart, where everyone gets a boost. A step toward maturity. This isn't just about boosting short-term earnings. Personal loan securitization shows that SoFi is maturing as a financial institution, capable of handling more complex financial instruments and risk management. It's like a teenager graduating from high school with honors and then heading off to an Ivy League college. Impressive and full of promise. By the way, if you are benefiting from the content so far and want more like this, hit the subscribe button, turn on the notifications bell, and comment the word more. Just go ahead and type the word more so I know. Now that you've commented, let's continue. But also note this. Bad companies can blow up your portfolio. Consistency is good, but might not compensate you for bad companies. The difficult part is how to pick great companies. Become a member to get member-only videos about stock updates that could change your financial life. Find the link in the video description section below.